Hi, I'm DHERSAN Chetty, equity analyst at Ford Asset Management. I'd like to discuss some of the trends and impacts of rising food inflation, which was a consequence of the war in Ukraine and came at a time when general inflation was already starting to rise. This, with higher fuel costs and rising interest rates, are placing significant pressure on the consumer, especially those in the lower and middle income brackets, where food and transport costs are a large component of their expenditure and tend to have lower savings and higher interest burdens. The net effect of these rising costs would result in the reduction of discretionary expenditure on non-essential items, while essential products such as food and healthcare will remain defensive. The net effect of these rising costs would result in the reduction of discretionary expenditure on non-essential items, while essential products such as food and healthcare will remain defensive. But a consumption squeeze still affects food expenditure as consumers reduce their monthly basket sizes by eating less, reduce non-essential foods such as sweets and snacks, switch to cheaper proteins, and buy down to cheaper products where the brand is not strong. Therefore, food companies with strong brands are better able to retain its customers, pass on those high price increases, but those with weak brands or in highly competitive segments are more likely to be impacted by lower volumes, lower price increases, and higher input costs. During these periods, food manufacturers are more impacted than food retailers, which uses their market dominance and bargaining power to squeeze the margins of the fragmented and competitive food manufacturers. Another trend is that consumers are likely to switch more into private label products, which are lower priced and have increased their quality given better sourcing by food retailers and higher margin since the retailers participate in the manufacturing profits. Also, consumers are likely to eat out less and migrate away from restaurants and expensive food delivery to eating more at home, creating a shift back to grocers. Food retailers generally pass through inflation, and these large price increases more than offsets the potential volume decline. In fact, food retail sales have been positive every year since records began in 1980, and volume growth was only negative in only 10 out of the last 42 years, with an average volume decline of only 1.6%. The worst volume decline was 5%, when food inflation was up 22% in 1992. This defensiveness has enabled food retailers to outperform cyclical sectors during periods of high inflation. However, we would see more promotional activity and retailers holding lower SKUs for bulk discounts, which would slightly reduce some of the inflation, which are largely funded by the food manufacturers. The pressure is more felt in the following year, as food inflation is typically lower due to the higher base effect and compensation in supply chains, and thus sales could be slower if the economy is not in good shape, with continued volume pressure. Overall, during periods of high food inflation, we prefer to be invested in food retailers over food producers. And within the Ford portfolios, we hold a large overweight position in SPAR and a lower weight in food producers. And we believe that SPAR offers significant upside from these levels, with defensiveness, high cash flow generation, consistent earnings growth, and a strong management team.